Are you an options trader that doesn't use risk graphs? My question would be, why? Why in the world would anybody trade options without using risk graphs? What we're going to do today is we're going to dive into risk graphs, how we use them, why we use them, and really more importantly, how to manipulate them to get the results that we need for our trading. My name is Chuck Fulkerson. Welcome, everybody. We're going to take about 20 minutes here, just kind of review what risk graphs are and how to use them. I speak to a lot of traders that trade options that don't use them, and it always confuses me as to why not, because they're such a valuable tool in your arsenal in order to at least have an idea of your reward to risk when heading in. You know, the beautiful thing about risk graphs is that a risk graph can tell me what the value of my portfolio should be, or the value of my position should be, based upon a movement in the underlying security, based upon a given time period, as well as based upon a volatility change. So we're going to do a quick introduction as to what risk graphs are and why we would use them. But let's start by taking a look at a chart. The chart that we have here is Shake Shack. Now, taking a look at Shake Shack, we can see right away that Shake Shack is in the upper 20% of its volatility, right? This is simply a volatility gauge that shows us the top 20% and the bottom 20%. Matter of fact, we're in the highest volatility for the last 1 year. Well, why is that? Well, that's because we have earnings coming up. So if you're a trader and you want to make an earnings trade, what's the trade that you can make? I know lots of traders who look to make good earnings plays. And oftentimes what they'll do is they'll look to trade, they'll buy a call, or they'll buy a put, or they'll do a straddle or a strangle, and they're not sure exactly which strategy makes the most sense. Well, that's because they're not sure how much the drop in volatility is going to impact their position. So what we'll do today is we'll look at what does a volatility crush do to your position. For example, look at this stock the last time they had earnings. You saw volatility fall right off the day of earnings, right? The prior earnings report, volatility falls right off. So how do we trade it if we anticipate a volatility crush? How can I make money to the upside if I think it's going to gap up? Which, by the way, I am making this is not about the direction of the security, but if theoretically you thought it was going to jump up on earnings, how would I be able to play that? What's the best way? And that's what we use risk graphs for. But before we get into that, I want to get into what are risk graphs, because I want to make sure that everybody at least understands what it is they are and how we use them. So looking at risk graphs, using and manipulating risk graphs, when I'm looking at a risk graph, I'm going to start by looking at the risk graph of stock, because the stock risk graph is the one that makes the most sense. Now, what you can see is that over here on the left, we have our profit and loss section. This is where we see our break even. Our profit is above the break-even line. Our loss is below the break-even line. And then our axis down here at the bottom represents the price of our security. 50, 55, 60, 65. Oftentimes you'll see this axis show up right on the break-even line, and we'll look at that when we go into our platform. But if I just buy a stock, well, my break-even is going to be the purchase price, right? My break-even is going to be the purchase price, which is 50. And as the stock goes down in price, my profit will go down, and I will have a loss. And as the stock goes up, I have a profit, right? This is essentially the risk graph of stock represents unlimited profit to the upside and unlimited loss to the downside, provided until it goes to zero, right? Well, stock has a delta of 1, meaning if the stock goes up $5, I make $5. If the stock goes down $5, I lose $5. So because it has a delta of 1. And so it doesn't really have any volatility to speak of or any theta time decay to speak of. So there's really no reason to ever look at the risk graph of stock. But you have to understand what a stock risk graph looks like as our foundation. So this is long stock. Well, here's short stock. In short stock, if we short the stock at 50, our break even is going to be 50. Well, yes, our break even is 50, but if the stock price goes up, we lose money. And if it goes down, that's how we make money. This is simply shorting stock. Do me a favor, leave a comment down below. Have you ever shorted stock? Is stock something that you've ever shorted? If you've not, why not? What's your biggest fear of shorting stock? And for most people, it's that this represents unlimited risk, right? You can see very clearly that if the stock continues to go up, your loss continues to get larger, right? Well, stock risk graphs are pretty easy to comprehend. when I'm looking at risk graphs, I've got to start by asking myself a question. How much is the maximum loss or maximum profit in the position? Right? Now, this is going to be based on long or short calls or puts. So we're going to draw a horizontal line at our maximum profit or loss. And then we find our break-even price. For call options, it's the strike price plus the premium. For put options, it's the strike price minus the premium. So, and then we're going to place a dot on the graph at our break-even price and then connect the max loss or the profit line to the break-even dot, and we draw a diagonal line. It sounds more complicated than it is, but let me just show you really quickly. So if I go long a $50 strike call for $3 a share, now remembering calls make money when the underlying goes up. So in this case, my maximum loss is $3. There's the horizontal line that we draw across our maximum loss. Our break even is going to be the strike plus the premium paid. So in this case, it's 53, which would be our break even. So we just put a dot there and then a diagonal line from our horizontal line to our short strike all the way up. And this is the risk graph of a long call. Now this shows me unlimited profit and limited risk. What about a short strike? Well, on a short strike, we have $3 as our maximum profit, right? Because we're selling the call. Break even is the strike plus the premium collected, which is still 53. And so once we go above 53, we see that we're losing money. So these are calls, right? Calls make money as the market goes up when I'm long, but when I'm short, I want it to stay below a certain price. How about a put? Well, if I go long the 50 strike put for $2 a share, the maximum loss is 2. My break even will be 48, and I will have an unlimited profit to the upside so long as the stock drops. Now, I say unlimited. In reality, once the stock goes to 0, that put can no longer make any more money. Now, what about a short strike? Short strike is $2, and our break even is 48, and we see that in this case we lose money as it goes down. And so our 4 risk graphs look like this. Long call, long put, short call, short put. And this sounds, and for most people, they've probably seen these. But what about, this is what they look like at expiration. They will look very, very different before expiration. So what, these are just the 4 basic risk graphs. What we're going to do is we're going to take a look at how do we adjust for the change in the underlying price. Now that's our delta and gamma effect. And we're going to look at how we change the date. That's our theta effect. The last thing that we'll look for is the change in volatility. That's our vega effect. So let's go ahead and jump over to the software, to the platform now. So as I jump into the platform, looking here at Shake Shack, let's just say theoretically that I wanted to buy a call on Shake Shack. Knowing that our current stock is sitting at 73, let's say I wanted to buy a call. So if I go to my Analyze tab, now I'm using the Thinkorswim platform as part of TD Ameritrade. They've got a very robust risk graph built in to this platform. You probably have the ability to have one of these in your own platform as well. And so if you do not have one, I would highly recommend that you go find an options risk graph or some sort of an options analyzer tool. But looking at Shake Shack, let's just say theoretically I was going to go out and buy the June call options. Now, the June call options, when I look at this, the $73 call option, the one that might makes the most sense as a purchase, if I'm bullish, would probably be this 77.50. Now, actually the 75. This 75 makes pretty good sense. I've got 1,200 contracts of open interest. I've got a delta of 53. I think the 77.50s actually might work a bit better with the delta of 48. That's going to get me a slightly higher gamma. But in this case, for this example, we're just going to buy the 53s. Now, looking at this, we're buying one of the 53s at the 740. So let's look at my risk profile. When I look at the risk profile, this is what I see. Now, there are 2 lines on this risk graph. So let's look at the 2 lines that we see on the risk graph. Down below, we see our price of the underlying security. So right there, we see 73. This 0 over here is my break-even point. So this break-even point represents the break-even price. Now the break-even price is going to be the $75 strike plus $7.40. So you can see this little hash here, and that shows my break-even on my expiration date. Now, in this case, we're looking at the June options, so my break-even on the expiration date is going to be at 75 plus 740, so $82.40 is my break-even price. But that's not the break-even price today. The red line represents the value of my position today. Notice the difference between the red line and the blue line. They're very different. Well, what is the difference between them? Primarily, the difference is what's called theta. What you see here is the difference in theta. The blue line represents the value of my position today. The value of my position on expiration. The red line is the value of the position today. So every day that time passes, this red line gets a little bit closer to the blue line. Why is that valuable? Well, what I might want to do is say, I plan on getting out of this trade. Let's just, for this example, say we plan on exiting the position on April the 1st. So we plan on exiting the position on April the 1st. So right here on April 1st, we plan on exiting the trade. So that day is April the 1st. Well, let's look at what my break even is on April the 1st. And what's great about this, to take into account what's called the theta effect, I can come right up here to where my lines are, and I can do what's called a day step. And when I day step my position, now it shows me that the blue line is 7 days from today. And as I day step it, 8, 9, 10. Now notice as I do this, you will see the blue line is getting further away from the red. Now down on the bottom left corner here, you will see my two dates. The red line is 2/17, the blue line is 3/2. And as I continue to step up, we'll step up until we get to 4/1. And what you'll notice is my blue line is getting a little further away from my red line. Now, looking at this line on 4/1, we can see that my break even on April 1st is $76.50. That's the anticipated break-even price on April the 1st. So going back to my chart, we know that in order for this stock to make any sense, I have to be above $76.50 on April the 1st. Doesn't seem like too hard of a task, but remember, that's only taking into effect theta, time decay. What about volatility? What do we anticipate happening to volatility? Well, by April the 1st, earnings will be over, and we anticipate that volatility will fall. Well, where is volatility currently? Currently, our volatility is sitting at about 57.29. On April the 1st, we will be well past our earnings date, about a month past earnings, and I think it's safe to say that volatility will be back in the range of 30 to 35. I think that's a fair assumption that we'll be back into this range by the time we get to this date. That's pretty much the range that it drops into about a month after earnings and stays there until earnings happens. So let's look and see what does my break even look like on April the 1st with a 27% decrease in volatility, right? Volatility going from 57 to 30. So going back to my Analyze tab, this is one of the very, very powerful features of this particular platform, is I can click this little cog down here on the bottom right, and that gives me the ability to adjust for volatility. Now, notice as I adjust for volatility, I've just taken it down 5%. So now we're down a 5% drop in volatility. And look at my break-even line. My break-even line on the blue date has already shifted up to 77.75. But remember, we anticipate a 20% drop in volatility. Now, with a 20% drop in volatility, my break-even line on April the 1st shifts to $80.64. So my break-even line has now shifted all the way up to about this range here, between now and the volatility spike. So I now have to have I now have to have price get all the way up to 80.64, which is right about here, before I'm at a break-even point on that particular date. And this is why risk graphs are valuable, because now you might say, well, what happens if it hits my stop loss, and what's my loss in the trade? Well, if it goes down, your loss will be worse since you've had that volatility crush. So this is where you start to look at other strategies and see, what do other strategies look like. So let's take this volatility adjustment back to 0. And now, instead of, so with buying the call, our break even is at 80.64 on that date. Instead of just buying the call, let's do a bull call spread. So we'll buy the 75, and at the same time that we buy the 75, let's sell the 90. Now in this case, we're buying one option and selling another. So we're buying the 75, selling the 90, and in this case we've created a vertical spread. Now the vertical spread risk graph, let's look at it on expiration, looks like this. We have a maximum profit at 90. At the $90 strike is where we hit our maximum profit. We also have a maximum loss. But because we've gone long and we've gone short, our Vega has been significantly neutralized. So now let's take a look at this. If I look at it again on April the 1st, so my break even, let's go back to my April the 1st date. My break even on April the 1st without a shift in volatility is now right there at $75.60. However, let's look at our shift in volatility. We anticipated a volatility change of 20%. So with a shift of volatility of 20%, our break even is now 75.70. So notice we shifted our excuse me, a little higher than that. I didn't hit enter. It's 77.87. So that 20% drop in volatility, $77 is now our break even. So a little bit lower, right? So now your break even is down in here. So essentially what you've done is you've said, well, my break even is not that much different now, and I've allowed myself and given myself more room in that position. And it might make more sense to be in this trade as opposed to another. Now, what's great about the vertical spread is you may say, well, instead, let me do the 70. I might do the 70 by 80 vertical spread instead of doing that. Instead of doing the 75 by 95. And now, when I do that, my break even is essentially at $75 a share. So I change the parameters of the trade, and instantaneously I can see what my break even is going to be on the position. In this case, now my break even is 75. So I've continued to lower my break even. And this is the best way that I know of to handle some of these positions. Matter of fact, the 70 by 80 bull call spread gives you a net delta of about 36, which is a really good net delta, and a debit of about $5 on a $10 spread. This is actually a really good spread, but you can see it better when you utilize the risk graph. So we will always want to look to see, what does a volatility adjustment as well as a time adjustment do to our options trades. If you are not using these, I would highly recommend that you do so. And let me give you one more example, and let's look at a stock that we could anticipate possibly a rise in volatility, right? So here's a look at Facebook, and where Facebook is today, we have just had earnings, and we've seen that volatility has fallen off. We might want to wait till volatility gets a little bit lower, but in this one we might see a rise in volatility between now and earnings, which are scheduled for April the 22nd. So if you're bullish in this particular stock and you believe that heading into earnings we'll see a rise in volatility, I can see, okay, what will my call be worth if I get out of the position on April 20th? right? If I plan on getting into a swing trade and I want to be out of it on April the 20th, but I anticipate a volatility increase of about 7%, what will that look like? All right, so let's look at Facebook. And when I look at Facebook, let's just say theoretically that I want to buy the June options. And I would do maybe, if I'm bullish, let's say that I do the June 220s with a delta of 47. And I can explain in another video why we would use this one. If somebody's interested in hearing that, just leave me a comment down below. We can talk about why we would use the delta of 47. It's specifically built around gamma. But let's say we're buying this one. So let's figure out what's this option going to be worth on April the 20th at, let's say that I have a target of 230. Let's say that my price target is we'll do 235. Let's say my price target is 235 on April the 20th, which would be before earnings, assuming volatility goes up from 24 to 34, so a 10% increase in volatility. So at 235, on April the 20th, I do my day step once again. So on April the 20th, I can add a price slice for 235. And I can assume, we're going to assume a 10% volatility increase. Now, that volatility increase of 10% might be a little bit aggressive on this particular example, but I just want to get the point across that the volatility increase, and I'm stepping it up so that you can see the change in the P&L. That volatility increase is important because that volatility increase shows me what my position might be worth at that particular price. So at that particular price, 235.99, which is what I typed in as my strike, I've got a profit of approximately $1,200 with a 10% volatility increase on that particular day. Now, why am I picking that day? Because I might want to be out before earnings, right? But that's the value of a risk graph. A risk graph can show me on a given date, based upon an increase or decrease in volatility, what is the theoretical price, the theoretical profit and loss of my position on that date. This is one of the best tools out there for options, and if you are not familiar with options risk graphs, please, you want to get familiar with those. We can do another video on this with probabilities if you want to understand a little bit more about probabilities. I will gladly throw that out there for you so that you have it. If you have any questions on how these things work, please feel free to send me an email, support@tradersarmy.com. Here for you anytime that we can. I hope you guys all have an amazing day. Enjoyed this video. If you like this video, do me a favor, leave a like, leave a comment, pass it on to your friends. I think it would be great to kind of share what it is that we're doing. Hope you guys all have a great day. Happy trading. See ya.